In the first few weeks this year, Tesla's market cap reached $830 billion to make it the fifth most valuable company in the world and making Elon Musk the richest man on the planet. While Tesla clearly is an absolutely incredible company built on exceptional battery technology, a really cool brand, and a great interface, amongst many other things, its stock price recently has become completely untethered with reality. And the reason this can be is because the stock market is not rational and does not price companies efficiently. So Tesla's stock has grown and grown based on pure speculation. And I'm not alone in thinking this. Michael Burry, who is famous for predicting the housing crisis in 2007 and portrayed by Christian Bale in The Big Short, is predicting a similar crash for Tesla today. So to explain what's going on here, in this video I'm going to cover why Tesla's stock has risen so dramatically in the last 9 months. Then I'm going to talk about how much I think Tesla stock is actually worth today. And then lastly, look at some examples from history and what might happen into the future. So there are two types of reasons why a stock might rise, and I'm calling these rational and irrational. So the rational reasons actually cause the inherent value of the company to rise. So for Tesla, this might be that the general market for electric vehicles is becoming more and more attractive, with tax benefits for owning EVs, with bans on conventional cars being announced, and generally people are becoming more environmentally aware, so there's going to be more demand for electric vehicles. Then looking at Tesla specifically, they are a market leader, and they have quite a lot going on for them. That could be their automation software, which is getting better all the time, and they have loads of other developments, such as in solar power or energy storage. And importantly, this year, they finally posted their first net profit. So then there are the irrational reasons that a stock might rise, and these are based purely on speculation, and this is where someone buys a stock because they think it's going to go up, but not because the inherent value of the company rises. So this has happened quite a lot over the past year with loads more retail investors. This is just normal people investing on platforms like Robinhood and E-Trade, and quite frankly, these people just haven't had much to do, and they've had lots of money because they haven't been spending it doing anything else, so they're just putting it into the stock market. And a lot of these people would have done that in companies that they really love, but they haven't actually put a true value on it. It's well established that people often assign a mental value based largely on the emotional imagery that companies evoke. And lastly, what happened later in the year was Tesla was added to the S&P 500, simply because it had grown in size, so it's going to be included on the list of top 500 companies. And what this means is everyone investing in index funds or mutual funds are now automatically investing in Tesla. More people are buying it, so the stock price goes up. So to put a true value on Tesla, we need to look at some numbers. So one way you can do this is by looking at their net earnings and then multiplying by a price to earnings ratio. And this is typically a ratio that is used to value companies. And Tesla's at the moment is around 1,300, which is absolutely ridiculous. So we then need to look at more typical PE ratios. So we could compare to automotive firms and tech companies. So firstly, looking at the automotive firms, an average PE ratio in this industry typically falls in the range of 7 and 12. However, Tesla is not a typical automotive firm, so it's not really fair to apply the average automotive PE. They're also a tech company and a battery producer. So a typical average in big tech is somewhere between 30 and 40. So for Tesla, I take a PE ratio somewhere between automotive and big tech. So let's take 20. So multiplying Tesla's net earnings of 700 million by this PE ratio of 20 gets us a market cap of 14 billion. So this type of valuation technique is not entirely fair on Tesla because they are growing tremendously. You'd use this calculation for a company that is really large, so they can't actually grow that quickly. So I would still apply that PE ratio of 20, but I'd put it on their size in the future. So to get there, I'd then look at how much could Tesla potentially earn when they are at their steady state size. So to do this, I'm going to estimate their future earnings, and I'm going to simplify the calculation by doing number of cars sold times by the price times by an average profit margin. So for number of cars sold, let's compare how much they're selling today with how much some of the biggest car firms in the world are selling. So this year they sold just under 500,000 cars. The biggest car companies in the world, like Toyota and Volkswagen, sell around 10 million a year. So taking into account that they're not exactly selling the cheapest cars in the world, let's say that they can achieve somewhere in between those two ranges of 5 million cars. Next, for the price, to sell that many cars, that it would have to be on the lower end of their scale. So currently for the Model 3, they sell at somewhere between 35,000 and 90,000. For this many cars, they probably have to be somewhere at the lower end of that scale. So let's say an average price would be £40,000. Based on these figures, Tesla would be making revenues of around 200 billion a year. Now this is reasonable because it is in line with some of the biggest car companies in the world. So lastly, we need to consider an average net profit margin. So this is, out of that revenue, how much are they actually taking away? So up until now, Tesla hasn't actually recorded a single year of profit. But this year they're expected to make a net profit margin of around 2%. But obviously they've been scaling, so this is expected to improve in the future. So the typical automotive industry net profit margin is around 5%. Then we compare with big tech. Apple's profit margin was around 21%. Alphabet's was also 21%, and Facebook's was an incredible 32%. But what you need to remember is that these tech companies, their costs are mostly fixed. They're mostly salaries, so as they scale up, their costs are going down as a percentage. With car companies, the main costs are variable. So as you scale, you still have the cost of the car itself and all the underlying commodities. So it's pretty safe to say that Tesla aren't going to make as high profit margins as big tech, but they're going to do better than a classical automotive firm. So we can take 10%. So putting this into our calculation, we've got 5 million cars times by $40,000 times by a 10% profit margin puts us at a net profit of around 20 billion. So at this size, Tesla really would be one of the biggest companies in the world in terms of revenues and net profits. So a PE ratio of 20 that we looked at before is pretty reasonable, because at that size we can say Tesla's going to be in a pretty steady state. They're not going to be growing really quickly. So this brings us to the moment of truth. How much would Tesla be worth? So with our net profits of 20 billion and our PE ratio of 20, that would place Tesla's market capitalization at $400 billion. So today we can say that the stock price is about double what they're actually worth, and that is if everything went right for them. So Tesla clearly is overvalued, and it's an incredibly risky investment. But you could still make money on it because there's so much speculation, and who knows how much further it's going to go up before it crashes down. Speculation and overvaluation is commonplace in the stock market. And it's happened so many times, and in its extremes it happened in the dot-com bubble, it happened in the housing market crash in 2007, and it even happened in the 17th century with tulips. A great example is Yahoo. So at the beginning of January 2000, its market capitalization rose to a high of over 110 billion, making it the most valuable company in the world. But at the same time, its net earnings were around 50 million, so its PE ratio was over 2,000. It would mean that it would literally take 2,000 years for its investors to get their investment back based on the earnings. But many people knew that it was crazy and were simply making speculative bets and hoping that someone crazier than them were going to buy it off them at a higher price. But eventually this bubble did crash in 2001, with its market cap falling to a low of around 8 billion. But I don't think something quite as drastic is going to happen with Tesla, because you can clearly see that their earnings potential are pretty high. But I don't think they can justify the price they're at today. At this point, I feel I should really clarify that I love Tesla. I think it's a fantastic company, and I wish I'd bought them at $80 a share. I just think that based on my assumptions that they are really overvalued right now, and we may be seeing another Amazon 1999 situation. The key message here is just to invest at the right time and avoid bubbles. I don't think Tesla's the only company that's overvalued right now. I think the markets are really overpriced. So check out my next vid, which is going to be on this and why we might see a market crash in 2021. Thanks for watching.